Welcome back to the Student Life Advisors podcast. My name is Trey.
I'm Elaine.
And we are going to be talking about paying for college beyond freshman year. Now, to do this, it won't just be us here having this conversation with you. We have a special guest that I would love to introduce. So I'm going to do that. Chris Ricciardi founded Edly Student Loans in 2019 with an ambitious goal to help address the student funding crisis by offering a solution that helps students underserved close the funding gap and complete their education. Drawing on more than 30 years of experience in investment management and higher education, Chris combined these passions to develop a unique funding instrument, income-based repayment, also known as IBR. These student loans are fully FDIC compliant and allow students the flexibility to repay based on their post-school earnings. Chris has served as the treasurer and a member of the board of directors of American Fund for LSE, London School of Economics, for the past 10 years, as well as on the advisory boards of the University of Richmond and the Robbins School of Business. He also founded the Ricciardi Family Foundation, which has a primary mission of supporting education. Prior to Edly, Chris served as the head of structured credit for Merrill Lynch, Credit Suisse, and Prudential Securities. Chris holds an MBA from the Wharton School of the University of Pennsylvania and a BA from the University of Richmond. Now, without further ado, I'd like to introduce our guest who's going to help us break down this conversation of paying for school beyond freshman year, Chris Ricciardi. Hey!
Great introduction. Thank you.
Thank you so much for joining us, because I think, we've been in this industry for so long. We've seen the ins and outs of people struggling. Freshman year tends to get all of that attention, trying to pay that bill, trying to get your foot in the door and start your program. But unfortunately, the anxiety and the stress of financial payments does not end freshman year.
That's the beginning.
It's just the start, because typically if you're in a 4-year program, you're going to have this conversation 4 times at least, never mind grad school or any other type of education beyond that. So, Chris, what are your thoughts on this type of topic? What do you think are some of the biggest mistakes students and families make when they're preparing to pay for college?
I think probably one of the biggest mistakes is not doing enough work up front to understand the return on the investment that they're hoping to get. Researching that, and there are tools that you can use to research it. So, for example, the Department of Education has put out a lot of data on College Scorecard. Your listeners may be familiar with. It basically contains historical outcomes from graduates and just attendees at all of the Title IV institutions in the country. So it's a great resource, and it contains a lot of information. And we would encourage people to do 2 things. One is to screen the schools that they're at or planning to attend, to see how past students have done at those schools. Did they, how often did they graduate versus withdrawing? Did they get high paying jobs or jobs in their field? Did they, have difficulty paying off the debt that they took, the federal student debt? That's what they report. So all of that kind of research is really important. And then also understanding, if you want to pursue some career, what it really means, right? What can you earn in that career? And that isn't the only reason. Money isn't the only reason to pursue a career, of course, right? But it is good to go in with your eyes wide open about what you can earn, and then what it costs you to get the degrees that you need to earn in that career path. And I think a lot of people don't do enough homework going into it. They just sort of show up someplace and say, well, if I work hard, and it'll all work out. And I think sadly that isn't always the case.
Completely agree, because students and their families, it's just about the idea of getting there. And sometimes once you're there, you kind of forget about the future. And the future has a huge impact on things like financial success and other things. When it comes to financial aid, I know you work a lot with students and their families, and you saw this gap of students that are underserved. I guess one of the myths out there is, if you get a certain financial aid package one year, people are thinking that they can rely on that for the future years, and they typically can start to get in trouble once they're already there. So beyond that type of planning for that first year, or even planning for the future on investment and what you expect to be able to do with that degree, what do you think some of the issues or struggles that families have when it comes to understanding that whole financial aid process and how that financial situation could impact them in the short and long terms?
Yeah, it is a complicated process, and there are government programs. There are basically three of them for undergraduates. They're Pell Grants, which are needs-based, and if you do qualify, you should certainly take such a grant. It's a non-repayable grant, but it's only up to about $8,000 a year. And then there are the Stafford loans, which those get a lot of attention, because they seem to be the subject of a lot of the, outstanding student debt and the forgiveness and all the rest. So those are basically what people are talking about. Those are the Stafford loans. Pretty low interest cost loans, so they're attractive in that sense. But they're only up to about $12,000 a year, not even in the first 2 years. And so together with the Pell Grants, you're looking at most about $20,000 a year through those two government programs. The truth is that, today, even in a relatively low-priced tuition school, the total costs of attending are high and higher than that. So you're going to have to look elsewhere for other types of aid or sources of funding. That could be school provided. It could be other private grants or scholarships. Those are available, and they should be maximized as much as possible, because those are all really good, even before taking on any student debt, even if it's low cost, low interest rate Stafford loans. So, and then, but even when you max out all of those, there's usually still a gap, and that's where, that gap is usually filled by some sort of parent loan. There's a government program called Parent Plus, and there are pros and cons to that program. The best part about it is it's relatively low cost in terms of an interest rate. What people don't like about it is it's not really a student loan. It's completely a parent loan. It can't be, refinanced into the government's IDR plans. It doesn't qualify for some of the employer benefits that I'll talk about a little bit later. And, all the burden falls squarely on the parent, right? And so for that reason, a lot of people don't like those. And then outside of that, it's the private student loans. And the private student loans so far have been, heavily cosigner oriented through most of the big lenders. If you look at the numbers, something like 92% of private student loans have a cosigner. And, that is probably okay if you have access to a cosigner that has a high credit score, but not everyone does. Right. And then there's a much more limited number of private student lenders that serve, that other 8% of the people that don't have a cosigner. And that is where Edly is. I mean, we do allow for cosigners, but most of our loans are to students without cosigners. And so, it's a complicated process, right? And you can see why people get confused going through it. And like you said, even if you get it, squared away for 1 year, then that next year, things can change again. And so you have to really manage it, every year of the process. And I would suggest just sort of going through that hierarchy of, what grants can you get first? Don't have to repay those. Then you start to, look at loans, go from like the lowest cost ones first, and then on from there. And, along the way, you have that fork in the decision, do you have a cosigner or not have a cosigner, or a parent who's willing to do the Parent Plus loans? And that is a complicated decision, but, every family has to make that decision as to whether and if the parent can contribute or not in that.
Yeah, as a student is making that transition from beyond freshman year to sophomore year and so on and so forth, what do you think about a student maybe not having the ability to pay and how that could potentially lead to them dropping out even if they've been in their program for a few years, like just navigating that decision and how do they navigate that?
Yeah, that's a real risk. And one of the reasons that's a real risk is, the schools themselves have varying amounts of financial aid that they can provide each year. And it's not always the same. And I'm sure they'd love to provide a great deal more than they are, but they're limited. And, all costs have gone up, including for the schools. And so they're feeling squeezed. A lot of the schools are feeling squeezed right now. They just don't have as many financial resources or the financial flexibility that they may have had in the past. And so it's a real issue. One thing that we suggest is that in order to qualify for certain loans, like Edly loans, and there's some others that are similar to us, we really look at the academic progress that the student is making. And it's not just GPA, but like, are they, moving, rapidly towards graduation? Are they going to be pursuing a, field of study that makes sense based on the historical outcomes from that school, things like that. And if they are, then they'll have more access to funding than they otherwise would be. Right. And if they're not, if they're at a school that's subpar or whatever, then the funding options really dry up. So it's really important that, you screen the schools up front to see how people who've gone there in the past have done. That's probably one of the best indicators of how you will do if you're in that school. Your access to funding, all the rest. So that's what we recommend. In fact, we do that as part of our regular process, but I would say just for any student who's going through that, whether they work with someone like Edly or not, they should be doing that analysis.
And I think you bring up some really good points there that, once you're in that program and you've done your research, and you've gone through a few years and you hit one of these financial gaps, that can be a really tough situation for a student to find themselves in. I was a student that, I kept wanting to scream every time I had a funding gap, that I was nervous about, sleepless nights, all the financial anxiety that comes with that, because it can have a very real effect on not only your everyday, just how you're feeling. It can impact you mentally as well, because that financial stress can cause a lot of anxiety. And I was someone who experienced that.
And then maybe you don't even take your test well because you got a financial stress that's causing you to not study and not pass, it's
more noise.
So much stuff.
Yeah, it's so much more noise constantly in your head. And I think you bring up a good point, because there were times a few years into my program where I'm facing a gap and I'm trying to figure out solutions. And thankfully, I had a family that could help me with some of those solutions. But I did know people who didn't have access to co-signers. They didn't have the ability to just go out there and say, well, someone co-signed this loan for me. They either had parents who couldn't or wouldn't. And you just want to scream because you're saying, I'm a top student here. I'm getting all A's. I'm doing really well in my classes. Don't you guys want to keep me here? And you go to the financial aid office and you plead your case that you're a strong student and you're doing everything you can. And sometimes the answer is still, we can't go beyond what we've done. They might increase aid here and there, but we do know what the college costs. $10,000 doesn't go very far sometimes when you could owe $50,000 to $60,000 plus to a school. So $10,000 sounds great. And it might look great, but when you actually do the math, you could still have a deficit of another $10,000 or more.
Edvisors is giving out a $1,000 scholarship every month, and you need to sign up for it. All you have to do is go to edvisors.com/monthly-scholarship. It's that simple. Sign up every month. You can enter every month. There'll be a winner every month. Just sign up for your chance to potentially be the one who walks away with that $1,000 to pay for your education.
So with those those students who are really, feeling like they're on the path to success and they're doing well academically, what's really great with the Edly solutions is that you get to use that as a way to potentially help yourself get through that funding gap. Could you tell us a little bit more about how academics play into some of the solutions that are available to students?
As I said earlier, Edly doesn't require a cosigner. There are ways to increase the approval rate and all the rest with a cosigner, but we do have, and most of our loans are with students who don't have a cosigner. So what that means is that we're doing what's called outcomes-based underwriting. So we're actually looking at the student themselves and the school where they're going. And we're really trying to figure out, if they look like everyone else who's gone through that school before and has, good academic progress, are they likely to succeed? And succeeding means graduating, and succeeding means getting a job that has a good salary. And it means, being able to afford the total amount of the debt burden that they took on. All of those things are reported by the education department for each of the schools. And then we also pull, transcripts on the students themselves to complete the analysis. And the reason we're doing that is because we want to, for two reasons. Obviously we want to put the money where there'll be success, right? Because that makes sense. And the other reason is a big part of our push is to actually get employers, future employers, I guess in the case of a student, employers to pay the loan payments. And this actually isn't as well known as it should be, but during COVID, when they were making a lot of legislative changes, they changed the tax law and allowed employers to make student loan payments for their employees, and it tax deductible for the employers and tax free to the employee, meaning that you normally, if you get certain types of benefits, you have to pay tax on it, you still have to come out of pocket. But they changed the tax law, and as long as the employer paid less than $5,250 a year, that you wouldn't be taxed on it. And this is not nearly as well known as it should be, but we spend a lot of our time trying to educate employers and employees who have student loans that they can get their employers to make these payments for them. Super helpful. Of course, that only works if you have a job, right? And you're important to your company. Right?
That's a good point.
That's why we spend a lot of time up front saying, all right, well, who's likely to get the skills that they need to get a job and be important to the employer? Because if they are, the employer is likely to pay off their student loans for them.
And I think that's really not well known at all, because what they kind of did when they passed that is they took the tuition reimbursement that's always been available for employers to offer to their employees, and they expanded that beyond just going to school to that repayment aspect. And obviously employers have to participate, or they have to make that eligible for their employees, but people don't really know that this is even an option. And it's not that employers are anti taking part of this, especially if they're part of the employer tuition reimbursement. It could just be that they're not aware of the tax change, or they're not aware of any employees who may be interested in these types of programs, and they might just need a notification saying, is this an option? Is this something we can do? And we have seen employers start to implement those types of plans to modify their tuition reimbursement programs to student loan reimbursement almost, to help them with that, because ultimately it's all paying for those degrees that got the employee in the door to begin with.
We think that's exactly right. That's like one of the biggest challenges we face, but what we work on every day is how do we increase awareness among employers and employees that this benefit exists. And in surveys, employees say that one of the top concerns they have is paying for student loans, and it just really stresses everyone out. And so to the extent they don't have to worry about it as much because their employer's paying, they're extremely grateful for that benefit and can really just focus on their work and not have to worry about those payments. So More and more employers are starting to see the light on that, and we predict that it'll become, just a regular thing that pretty much all employers do in the future. But right now, a small minority of them do it. So we really got a lot of work to do to make sure that really happens. That for us is the future of the solution to the student debt problem, is getting employers to repay these loans.
Yeah, and if there's a window for them to do that on the tax side, I think, that could totally grow and be an effective way of making this advantageous for the employers and then the employees as well. So in touching back to that, the employee or the student who's coming in and thinking, okay, I hear this income-based loan, this sounds interesting. However, I'm more familiar with the traditional loans. How would you break it down to them so that it's simple and easy for them to digest, so that they know, okay, this is the way this works and how it's different from what I'm used to?
So we use income-based repayment loans as the way to repay, instead of a fixed rate or a floating rate that's based on some index like LIBOR or so forth. And the reason that we do that is because we feel as though it's a lot more comfortable for students to sign up to a percentage of their income. Say, okay, this is going to cover my gap, right? It's going to be this percentage of my income when I get a job and need to pay it back later. And I know I'll be able to afford it, or should be able to afford it, because it's a affordable percentage of income. As opposed to a fixed rate might sound good in the sense that it's a knowable amount of payment that you have, but that may or may not be affordable depending on how your circumstances change, right? And then we think the riskiest of all of the loans for a student borrower or a cosigner or parent borrower is a floating rate loan based on some index like SOFR, which I can guarantee you almost none of the borrowers understand how SOFR is moving in the market, and very few of the market participants even do, because it's a sort of arcane instrument. But it's heavily tied to what the Federal Reserve interest rate policy is. It's gone up a lot recently. There are a lot of people started with a rate that was one thing, and now it's several percentage points higher.
Several.
Right? Oh,
Several.
goodness. That's an understatement.
It might go down again, probably will at some point, but it doesn't seem like the students and their parents shouldn't really be gambling on the direction of interest rates. Right? That's not really something that they're well equipped to do. And so in our minds, a much better way to do it is just income-based repayment. It is the way that student loans are funded in many other countries, like the UK and Canada. And in the US, when you get into trouble with your fixed rate federal student loan, the Stafford loans, they'll refi it or modify it into the income. They call them income-driven repayment plans. The old way was income-based repayment, but it's the same thing. So because they realize, we realize, right? It's that you can only pay what you can pay. Like you can only pay an affordable percentage of what you make, right? There's no other way to do it, and so you might as well just come out up front and say, all right, well, this is what it is, right? And I know that the current administration, the Biden administration, is making a much bigger push to get all the old borrowers into the income-driven repayment plans, and even modifying it to make it a little bit more attractive, which we applaud. That's absolutely the right answer for that. And it makes all those payments much more affordable, income-based. So by definition, it'll be a percentage of what you make. And it doesn't mean it's always going to be easy. You have to budget and all the rest, but it makes them inherently more affordable. And we think that's a good thing, and that's why we do ours that way. And we just think it's going to be the way student loans are done in the future.
Edly might be ahead of its time.
A lot of the help with that is, one of the biggest risks to students, one of the biggest risks of running into problems and running into financial problems is that withdrawal. If you withdraw or you're unable to complete your program, your chances of a successful student loan repayment drastically drop. So finding different types of options, alternative type of options, like something like an Edly IBR loan, can really be helpful for students who can qualify. Now, once again, you always have to look at the terms and the conditions to see if you're eligible. And as we know, with most private lenders in any space, they might be a little bit more specific on what type of schools they work with and what type of students they work with, especially with that outcomes-based underwriting, which is essentially what the entity is even allowed to loan to or offer these funds to. It can be really restrictive. But if it is an option for you and you are running into a funding gap, it lets you understand ahead of time. You're looking at, so I think all the pieces of advice you put together of looking ahead of time, what's your return on investment, what can you expect to make in the future, then if you do go with an option like an income-based loan, even federal repayment or private, you can get an idea with already understanding what your income's going to be around what your payment can be to help you for future planning. So I think that helps you bring full circle on how some of these income-driven, income-based type of repayment options come together, is in the end, you can make some educated guesses. Because once again, it's still guessing. You still don't have a job when you're in school, most likely. You still aren't exactly sure where you're going to be. But if you looked at some of these numbers ahead of time, you can give yourself an idea of what you can expect. If your income goes higher than that, that's fantastic. And if your income goes lower, there are protections both in the federal side and some of these types of solutions, which we've seen from Edly and a few other companies, where there could be a protection where payments may not be required or payments can be reduced as far as the federal program goes. So I think it's really, really helpful to ease some of those financial anxieties, some of those sleepless nights, but because we know sleepless nights might start when tuition bills come, but they do not end, from experience, until the loans are gone, because the loans will be over there and they do follow you around. We talk about forgiveness here and there. We talk about options here and there. Interest rates have been, something people have used in their strategies, but right now some of those strategies are on hold for refinancing for better rates and locking yourself in because the world is changing. The world is different right now than it was even 2 years ago or 3 years ago. So Chris, I think that's really, really helpful. Do you have any final thoughts on how you think students should plan or pre-plan in order to avoid any other types of anxieties or any other issues when it comes to paying for school and beyond, getting rid of those loans and getting through successful payment?
Yeah, I still think, one of the most important things is to, be realistic about what you're hoping will happen and research things up front, research the school up front, what happened to people, who went there previously or studying the same thing. And you'll learn a lot from that, right? If you want to be in whatever career, and you can literally see, because it's reported on College Scorecard, like other people who studied in that major, like what happened with them, what salaries did they, what was their dropout rate, what was their default rate, all that information is there. And you can buck the trend maybe, but probably not, right? I mean, like these historical numbers actually carry a lot of weight. And it's important to sort of go to programs where people have had past success. It's much more likely you're going to have success also.
I think we covered everything. Would you say so?
I think we got through a lot today. I think we went through a lot of information, super helpful in understanding your options out there, as well as some of those alternative options when you do run into problems when you're having trouble paying tuition. And it's not even freshman year, you might be in junior year or senior year, which then it's hard to make those decisions if you hit hard obstacles.
Absolutely. And so I've got a question. Chris, in one sentence, if you had to give a student or even a younger version of yourself going to school one piece of advice, what would you give them?
Well, I guess I would say, definitely work hard and keep an open mind. Talk to a lot of people and listen to what they say and be a sponge, just absorb everything. There's a lot of information there, a lot of smart people in the world that, everyone knows and certainly are coming in contact with them at schools. So, it's a great opportunity just to absorb it all and keep an open mind.
Oh, that's a good one. Work hard, keep an open mind. I like that. I don't know if we all approach to paying for college beyond freshman year with that perspective. So that's pretty good. That's informative. Well, thank you, Chris. Once again, we're so grateful to have you as a guest, to have you bring your expertise to the Student Life Edvisors podcast. This is going to help so many of our listeners and let them know that there are alternatives out there and solutions that exist to help them pay for college beyond freshman year and even from the jump as well. So thank you for your time. And that's going to do it for this episode of the Student Life Edvisors podcast. Once again, my name is Trey.
I'm Elaine.
And we had our wonderful guest, Chris Ricciardi, joining us today. We hope this podcast helped you, and make sure that you stay tuned for other episodes that we've got in the lineup for you. Thanks.